everyone. Welcome to Crack the Code, Take Control of Your Retirement Money or Retirement Accounts. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with Checkbook-controlled. Our presenter today is Brad Sininsky, and I briefly want to introduce you to Brad. He is a solo 401k and SDIRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brad is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Thank you again for joining us today, Brad. I'll let you take it from here.
All right. Thank you so much, Leah. Appreciate everything. You can hear me okay, right?
I can hear you perfectly.
Okay, cool. And since I don't think we saw a thumbs up or anything from anybody in the audience that you can hear us, so we're going to just move forward as if you can. If you have any problems, put them in the chat or leave the meeting and come back in, and maybe that'll fix it. There's a thumbs up. Thank you very much, whoever did that. All right. So yes, welcome to Crack the Code, Take Control of Your Retirement Accounts using one of two vehicles, or actually both, and I'll explain why you might do both: the self-directed IRA and the solo 401k. We are not a fiduciary. We don't provide legal, tax, investment, accounting, or other professional advice. If you need such advice, please seek out a competent professional in that area. First of all, why us? Well, we have a lot of clients, and we've actually helped well over 3,500 clients establish over 4,000 different types of self-directed retirement accounts. We have 5-star reviews online. It's not hard to find: Better Business Bureau, Bigger Pockets, Yelp, Google, etc. And we've been in business since 2010, so we're well past the startup phase. And at this point, most of our business comes from referral. We do some marketing. We do webinars like this that we promote, of course, but I would say probably 80 to 85% of our business comes from our current clients. And that's a testament, in my mind, of their satisfaction, or maybe even more so, excitement about working with us. And so our mission is to help clients obtain control and protect their retirement accounts. Proverbs 21:5 says, "Good planning and hard work lead to prosperity." And you work hard for your money. We want to come alongside you and work hard in this capacity of providing a vehicle for you in collaboration with you to further accomplish your goals in retirement, and hopefully retire with some dignity and a nice stream of income. And so I want to talk first about the difference between conventional and self-directed retirement. Well, conventional is like a bus, okay, or a train that has to stay on a certain track or a certain route. You have to go to the stop to get on or off, and you have to get picked up or get a ride from or walk from the drop-off destination. And so it's effective to a point, but it is relegated to a certain routine that you can't deviate from. That's the conventional side. That's the stocks, bonds, mutual funds. ETFs are a little more creative, but haven't been around as long. But nevertheless, I'll throw them in that conventional side. And then on the other side, you have the self-directed retirement. Okay, so this is the off-road vehicle that can go anywhere the bus can go, over those tracks. It can go over rocks. It has a higher clearance. It can go through some water, on streets, etc. That's the self-directed side. You guide your investments in the direction you want them to go and in the asset class you want them to go. There are some restrictions we'll talk about, but it's pretty nominal compared to what it actually is capable of doing. And so that's what we're going to focus in on. Speaking of which, we believe, and I think it's hard to argue, that the self-directed side of retirement investing is what provides true diversification. So yes, you can invest in the S&P 500 and have a little bit of the 500, maybe strongest or wealthiest or whatever you want to say, companies in the country. And there's some value to that and a sense of diversification. But at the end of the day, it's still in real estate, secured by a business that you have no control over. In the self-directed side of things, you can invest in real estate, both commercial and residential, you can invest in tax deeds, you can become the bank, you can be a private lender. That's one of the things. Real estate and that are probably the two most common investments because they're secured by real property, and so they're pretty secure and safe compared to some other investment options. You can do precious metals, you can do crypto, which is the hot topic these days, it seems like. And really, the sky is almost the limit. In fact, the IRS doesn't tell you what you can invest in. It would be impossible to create an exhaustive list like that. They actually just tell you what you cannot invest in, which I'll share a few slides from now. And speaking of diversification and not putting all your eggs in one basket, Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And that's very true, right? I mean, we seem to be headed towards some good prosperity here in the United States. Anything could happen. Last time we had COVID kind of seemingly come out of nowhere and things shut down and then turned right back on, it seems like, and everything went wild. But if you were diversified, you probably didn't have a blip in your portfolio. If you weren't, and maybe you were in all the stock market, it's probably come back by now, but there was certainly a blip. So you just don't know what's going to happen. And of course, going all the way back to 2008 and 9, which was a disaster for a lot of people, if you had been diversified and not just in the stock market, you probably would have been affected much less as far as your retirement portfolio is concerned, and even personal portfolio for that matter. But that's not what we're here to discuss. First off, an example of some clients, Brad and Jennifer. They are real estate agents and have been in the business a long time. And Brad approached us several years ago and said, hey, I want to diversify my retirement. I've been, done well in the stock market over the years. My IRAs, former W-2 employee 401k plans have done well. I've got a fair amount of money in there, but I really want to diversify. And I've heard about this thing called a solo 401k where I can have it because I'm self-employed and I don't have any non-owner, non-spouse employees. So let's talk about that, right? So we established a solo 401k for him, and he started investing his money into real estate, primarily rental properties, single family and multifamily. And as a result, they now have millions of dollars worth of real estate in their Roth 401k, which is super cool because, as you know about Roth, if you do, then it's you pay taxes on the contributions or conversions today, but take it out tax-free. So they're over 59 and a half, so they can already take tax-free ATM withdrawals if they would like. And that can be the assets, by the way. Like if they want to live in one of those rentals, they can distribute that asset to themselves, and it's completely tax-free. Super duper cool. Anyway, so that's an example. So we have two options, as I alluded to at the beginning. We have a self-directed IRA and a solo 401k. And the self-directed IRA is for just about anybody. Typically, you're going to roll money in because the contribution limits are fairly low for the IRA. So it's hard to invest in alternative assets if you start out with zero and just fund from contributions. So typically, you're rolling existing qualified money into an IRA, whether it's Roth IRA or pre-tax IRA. And then on the solo 401k side, we do have a lot of clients start out at zero because the contribution limits are much higher, over $70,000 if you're over 50 and $70,000 if you're under 50 annually per participant, by the way. So if you have a married couple participating in the same solo 401k, you can double all the benefits. It's pretty cool. And so a lot of people start out at zero because you can go from zero to $140,000 in a year or less if your sponsoring business is robust enough and making enough money to max out those contributions. And then you can take advantage pretty easily of some alternative asset, non-Wall Street type investing. And so how does the IRA work? Well, let's talk about that first. But I will preface this to say there's two different types of self-directed IRAs. There's a self-directed IRA that is really just called a self-directed IRA, where you go through the custodian for transactions, for investments. All real estate, all contracts and everything are in the name of the custodian for benefit of your IRA. And so there's nothing wrong with that other than you lose a little bit of control, and because you can't necessarily control the timeline on things because you have to go through the custodian and they have to sign everything and kick it back. And then of course, title for real estate, whatever else is in the name of the custodian, as I mentioned. If you want more control and less red tape and transaction fees, potentially, we had actually had somebody who had I didn't really understand the fee schedule, and I don't remember if maybe I didn't hear who the provider was, and I wouldn't say it on here anyway, but they were with a competitor of ours, and they had about $800,000 in assets, mostly in real estate, inside their self-directed IRA, not a checkbook IRA, which I'll explain. And their annual fees were over $2,500. If they had an IRA with us, it would be a checkbook IRA, which again, I'll explain in a moment how that works. And their flat annual fee would have only been $250. So 10%. I mean, it's a massive difference. Anyway, I digress. So you have the self-directed IRA that you go through the custodian for everything. And then you have the checkbook IRA, which allows you to bypass the custodian in the way that I'll demonstrate here on the screen in a moment. First off, we cannot eliminate the custodian. We can only bypass them in the IRA. So the first step is to open a new account with an IRS-approved custodian, set up a qualified transfer from an existing retirement account, a 401k, a 403b, a current IRA. By the way, this can be Roth or pre-tax. If you want to do both, it's going to have to be two separate self-directed IRAs, one Roth, one pre-tax. But if it's just one, you only need one. And then a special purpose LLC is created. This is a single member LLC. The member is the IRA, and you are the manager of this LLC, which is where all the assets and all the accounts are actually held. And so you're a non-member manager, which gives you the power to make investment decisions, sign on the dotted line, open accounts like the next thing over there, which is that bank account that's opened. You do that in the name of the LLC. And then what happens when the money's transferred, it goes from custodian to custodian, and then it goes into the custodian account. And then from there, it's going to go into the bank account. This is cash into the bank account that the LLC has opened up, right? And into the LLC. And so once this is all done, you're ready to self-direct. And so all the income and all the expenses go into and out of that checking account. Now, when I say checking account, that's literally what I mean. People get hung up on this, like, I don't get it. How does it work? Well, it's literally a checking account. It's a bank account that has check writing ability. If you order checks, you don't have to. It has a debit card, it has online bill pay. And so you just treat it like a regular checking account, and all the investments are treated just as such, as investments. You can't personally take advantage of these investments as far as like using them for your own use or getting paid for managing or doing work. You can't do the work, and I'll explain more what I mean by that here in a few slides. So they're just investments. Think about if you were my fiduciary and you're investing on my behalf, you're not going to personally use anything. I might pay you for that, so there is an exception there, but you're managing another entity's money and investments, and that's the same thing that you're doing here. So that's the checkbook IRA versus the regular self-directed IRA. And we only do, to be clear, we only do checkbook IRAs. We do not do the regular full custodial self-directed IRA. So let's transition to the solo 401k, which we're going to spend more time on. First off, how does it work? Well, you need a plan sponsor. Unlike the IRA, which anybody can do, you can actually, with the solo 401k, you need self-employment activity. It's not hard to be self-employed. If you're not, you could drive for Uber one day a month, get your real estate license, mow lawns on the weekend, sell stuff on eBay, go get a network marketing position for Amway, whatever. I mean, if you have the potential to receive a 1099, you're self-employed. If you have an S Corp, an LLC, a C Corp, a partnership, all of them can sponsor a solo 401k plan, a sole proprietor as well. And so once it's established, okay, I qualify for the plan. By the way, in addition to that, you can't have any full-time W-2 employees outside of yourself, a spouse, and any owners. So no non-owner employees and no non-spouse employees, or non-spouse employees, I should say. And then you can qualify for the solo 401k. And so once that's established that you qualify for it, then we start the process of creating the plan and the adoption agreement and the special purpose trust. And the 401k is a trust. And so all the assets are actually held in the trust of which you're the trustee. So unlike the IRA, where you must have a custodian, and we bypass them with the use of a special purpose LLC, with the solo 401k, there's no requirement to have a custodian. So there's no bypass, there's just kind of elimination. And there are other companies that offer solo 401k plans for sure, not just like we do, but also more in a more traditional sense where you're just going to be in Wall Street. And so in those situations, you have a custodian to go through. Now, I'll explain here in a minute why you can use our solo 401k plan to also invest in Wall Street. But let me finish this slide and then I'll talk about that in a sec. So you're the trustee, which gives you that checkbook control, the check writing authority, the signature authority, investment decision-making authority, all of it for all the assets on behalf of the solo 401k, which also gives you the ability to open a bank account. And you'll see any bank account at any financial institution or brokerage for that matter. So I said brokerage. Okay, so you can, a lot of people want to know, this is like a question that comes up in every webinar, so I'm answering it now. By the way, if you have questions, put them in the chat. Happy to answer them towards the end. But if people are like, okay, I have this checking account, I'm not really sure what to do with the money while I'm looking for the right investment. I don't want to roll $300,000 into this checking account and then not have any interest earning on it, or very nominal, because it is technically an interest-bearing checking account, but it's nominal. So what do I do? Well, what you can do is you can also open a non-custodial, non-prototype brokerage account at Vanguard, Fidelity, T. Rowe Price, Schwab, Edward Jones, wherever you want, and you can invest in what that brokerage offers, stocks, bonds, mutual funds, and ETFs, but still have it be inside the solo 401k plan. Okay, so they're not going to issue any tax reporting or anything else because they know that you're using their brokerage inside of another plan that they did not put together for you. And so that's an option as well inside the solo 401k. A little more difficult in the IRA to do that, but the solo 401k is it's very doable. And also, and this comes up not often, but sometimes, you can even take some of this money and you can put it into the hands inside the solo 401k plan, into the hands of a financial planner. If you want somebody to actively manage your money, you don't necessarily have to like open a new account with them. You can just, because you're the trustee, you can sign on behalf of the solo 401k and they can manage some of your assets. So you could have financial planner, stock market, real estate, crypto, precious metals, kind of all of the above. So when I say this provides true diversification, it really, truly does. And so all the income, again, just like the IRA LLC, all the income and expenses are going into and out of this checking account, which is the home, quote unquote, for the funds until it's deployed into an investment of choice. Not going to talk about that. Okay, so the contributions. On the next slide, I'll really break it down, but just know that you, as being self-employed, you are an employee and you're the employer. And so the IRS allows you to contribute in both ways, as the employee and as the employer. And both of these contributions can total up to $77,000 a year. So what comes up sometimes is people are considering or already have a SEP IRA, and they're asking, what's the difference between this and the SEP IRA? Because the maximum is the same. And while that is true, you get there faster with the solo 401k because the SEP IRA only has the employer profit sharing contribution, which is 20% or 25% of the W-2 to get to the 77, where, and I'll show you more on the next slide, with the employee and the employer combined, you can get to that max a lot faster. Proverbs 21:20 says, the wise man saves for the future, but the foolish man spends whatever he gets. So yes, if you have a business, definitely encourage you to put money aside, not just for taxes, because the self-employed can struggle with that for sure, but also for your future, for your retirement time. And the solo 401k is a great vehicle to do that. The best, in my opinion, and many CPAs will say the same. Okay, so here's how the contributions work. As the employee, also known as the elective deferral contribution, it's up to $23,000 per year, $7,500 on top of that if you're 50 plus. And this can be up to 100% of your self-employment earnings. Okay, so what I mean by that is if you are a sole proprietor, single member LLC, you're not running payroll, right? It's based on the income of the company, the net income of the company. And so if your net is $10,000 and you don't need that to live on because this is a second gig for you on top of your W-2 job, then you can put that whole 10,000 in to the solo 401k as an employee elective deferral contribution. Okay, it's dollar for dollar. It's up to 100% of your self-employment earnings. Now, not quite 100% if you, well, it is technically. On the W-2 side of things, you do have to, like if you're an S Corp, C Corp, and you're running payroll, which is required for those types of, that type of tax filing to qualify to sponsor a solo 401k, the contributions have to be made through payroll. If you're going to max out, the 23.5, you're probably going to run a W-2 for the year of at least 25 because you do have to account for FICA and Medicare and that sort of thing. So, so up to 100%, not quite dollar for dollar as it is like in the sole prop side, but still you're on the sole prop side at the risk of getting into the weeds. You're reducing the self-employment, I believe, tax in half to get your kind of adjusted earned income to figure out what you can contribute. And by the way, on this notion, we do have a calculator on our website under Solo 401k contributions calculator that you can play around with to see what your situation looks like. These contributions can be either pre-tax or Roth. And then on the employer profit sharing side of things, it's always a tax deferred expense for the business. And again, up to 25% of the self-employment compensation if you're S Corp, C Corp. And then if you're sole prop, single member LLC, it's 20% of that profit that I mentioned. And so the total limit for these is 77.5 if you're over 50, 70 if you're under. And then for 2024, 69 or 76.5. And so it's actually not too late to make some contributions for 2024 if you haven't filed your taxes yet. So I'm not going to get into the weeds on that, but if you want to ask me some questions at the end about that, if you're interested in 2024 contributions, type them into the chat and we'll address those for sure. You can use leverage in an IRA or 401k. You just can't provide a personal guarantee. It must be a non-recourse loan. They're still going to run your credit and look at you to make sure you're not a criminal, but you're not personally guaranteeing the loan is going to be paid back. If there's a default, then the property is the only security for the lender to actually come and foreclose on. They can't ding your credit. They can't go after you, put a lien on your personal assets, residence, whatever else. It's just the property. It's like a DSCR loan, but still a little different because with the DSCR, you're actually still providing a personal guarantee. This is DSCR on steroids. It will require 30 to 50% down, and it needs to cash flow $100, $200 a month. And you do usually need to have about 6 months or so of cash reserves. And it's important to note that if you invest in real estate with an IRA, it will trigger what's called an unrelated debt finance income tax that actually turns into UBIT tax for the IRA to pay. And so just know that that's a thing. Again, kind of like the 2024 contributions. I'm not going to get into UBIT on leveraged real estate unless you guys have specific questions, but you can see a list of lenders and banks on our website at SenseFinancial.com/non-recourse lenders. So check that out. Okay, disallowed investments. So I said the IRS doesn't tell you what you can invest in. They only tell you what you cannot invest in. So that's a couple things. Collectibles, so baseball card stamps, cars, some precious metals that are not approved, art, People did this and abused it. I'm sure they invested in Lamborghinis or something and then started driving them around. But so no collectibles and no life insurance in the IRA. Okay. Now, outside of that, the only other kind of category that goes along with disallowed investments is what are called disqualified persons. So all of these combined, the disallowed investments and the disqualified persons, not necessarily combined, but either one of these would create what's called a prohibited transaction. And so you want to stay away from that in both types of retirement accounts. In the IRA, it can actually kind of eliminate the whole IRA as being a qualified account. And so it can be just a giant distribution, which you just want to stay away from. And you definitely don't want to trigger any audits, which, by the way, if the IRS gets wind that you're committing a prohibited transaction or investing with a disqualified party, that can, and you probably should just bank on that, will create an audit situation. So stay away from it. It's easy. It's like driving down the freeway and using your seatbelt and stopping at the stop signs and mostly going the speed limit, right? You still drive and you don't necessarily like wearing your seatbelt or stopping at the stop sign maybe, but you still do it because you're going to use your vehicle. It's the same thing with this. Just follow the rules and everything's fine. And you can make a lot of money. And so the disqualified persons are you and your immediate family. It's the lineal descents, okay? You and your spouse, your parents, your grandchildren, and your parents, your grandparents, your children and their spouses. Okay, so that lineal descents. Now, you and your spouse are not lineal, but Bible says you and your spouse shall become one. Okay, so you are one, even in the eyes of the IRS. And so none of those people can, if they hold a controlling interest in an investment opportunity that you're considering, you can't invest with them. Okay, none of these people can get paid or be compensated by the plan, the IRA or the 401k. None of these people can go stay at a property that's owned by the retirement account. Those are probably the best examples, but also think about it like this. The other caveat is none of these people can provide services to the retirement account. Okay, so if I'm a real estate agent, I can't sell the IRA owned property. Okay, I have to just third party completely get that out of my wheelhouse and hire another agent. I could represent it on the front side because it's pre-acquisition. I just can't get paid. I'd have to give up my entire commission as like a closing cost credit or price reduction because now the IRA or 401k is benefiting and not me. But once it's owned, I can't represent the plan in a transaction like that. You could technically manage it, but think about it like this. White collar work is okay, blue collar work is not. So you can't do any blue collar work. I probably wouldn't even go show the property to prospective tenants. There's different schools of thought on that. Maybe it's okay. I probably wouldn't, but we're a little more conservative here at Sense Financial in this approach. So yeah, pretty much anything you can do behind a computer is okay. Hiring somebody, walking through the property to make sure that they're putting the right tile in and doing it properly per your desire is okay. You just can't lay the tile or swing the hammer yourself. All right. So I'm done belaboring that. Not going to talk about that. Okay. So here's a quick snapshot of the self-directed IRA versus the checkbook IRA versus the solo 401k. All right. So this always helps me kind of remember anything I didn't mention. So they all allow for non-traditional investments. There is a custodian required in the IRA, not the 401k like we talked about. Checkbook control with the IRA LLC, 401k, not with the self-directed IRA. Transaction fees, yes, and then no for checkbook control. There is LLC fees, so just something to bear in mind, depending on what state you establish the LLC in, which we do for you, by the way. You just tell us what state you want it in. Then we can, then you're just going to have to know you're responsible for the filing requirements annually. We'll set it up, but when it comes to like an annual tax or annual filing or anything, that's on you as the client. And then the IRA does not allow for a personal loan, but the 401k does. So this is 50% or 50,000, whichever is less, and you can use that for any purpose, paid back over 5 years. If you use it for a primary residence purchase only, then it can go up to the 15-year amortization. Otherwise, it's only 5. And again, you can use that money for anything because it's your money. You're borrowing it. You're paying back the 401k or the 401k. And so oftentimes people use that loan for what would otherwise be a prohibited transaction. Like, for example, we have more than a few clients who are have used the participant loan to fund fix and flips that they're doing personally. And then once the property is acquired, fixed, and flipped and sold, then they pay off the loan. There's no prepayment penalty. And so with UBIT, we talked about very briefly, but I didn't say this. The solo 401k is exempt from UBIT on leveraged real estate. And there is 2 ways essentially that UBIT is triggered. There's from leveraged real estate and an IRA. And then if the retirement account, 401k or IRA is running an active business, then the income from that is going to trigger that tax as well in both plans, 401k and IRA. But again, on leveraged real estate only, the solo 401k is exempt, which makes the solo 401k a superior product from that perspective. And then the max contributions, of course, are vastly different in both plans. And there is this super catch up if you turn 60, 61, 62, or 63 in that year, then you can do the super catch up of 11,250 instead of 7,500 only. And so that's cool in the 401k. And then the 401k has Roth and pre-tax built into it. So when it comes to really just supercharging your Roth either through conversions or straight contributions, it's really a lot easier to do it inside of a solo 401k than it is with an IRA only situation. And then, of course, self-employment required for the solo 401k. If you do want to talk, I'm happy to just grab a spot on my calendar, SenseFinancial.com/consultation. Happy to get on a phone call. We'll get to understand your situation and ask you some key questions. If it makes sense for you to become a client, great. If not, that's cool too. I promise you're going to leave with information you didn't have before on that. But now we will take any questions that are in the chat.
Yes, we do have a couple of questions for today. And the first question is from Joseph. He asks, can you please spell out the pros and cons of Roth 401k versus regular 401k?
Yes. Okay. Thank you. So, so Roth, IRA or 401k operates the same, right? With pre-tax money, you are putting the money in the plan before you pay taxes on that money. So it's reducing your taxable liability for that year, that tax year, by whatever contribution you make. It's tax deferred. Okay. That means at retirement, 59.5 when you take distributions, it's added to your earned income. Now, at 73 currently, which will probably be 75 later, but 73 currently, when RMDs kick in, those required minimum distributions are also added to your earned income in a traditional pre-tax account, 401k or IRA, it doesn't matter. In Roth, you are paying taxes on it today, but not at retirement, not upon distribution. And there are no RMDs, required minimum distributions inside of a Roth. IRA, 401k, it's all the same. Okay, so that's the difference there. The reason I think, let's see. Oh, that question was asked pretty early on at 11:02. So probably maybe I repeated some of that you already heard, but that's okay. It's a good question. When I mentioned conversions inside the solo 401k from pre-tax to Roth being easier, it is because both of those types of funds can be inside the same plan. So logistically, remember I said you have a checking account? Logistically, to keep them separate, you have a checking account so this is all under the solo 401k trust, right? You can have multiple checking accounts underneath this trust account, which is the main relationship with the bank. One account would be traditional pre-tax, and one account would be Roth. And that's how you separate the funds. So if I have a house that's traditional and a house that's Roth, then all the rent payments for the Roth go into the Roth account and all of the traditional payments go into the traditional account. So that's how you keep it separated from an accounting perspective. Just like if you had a Roth IRA at Vanguard and a traditional IRA at Vanguard, they're two separate plans. It's the same thing, but they're really two separate plans. With the solo 401k, it's the same plan, but separate accounts. So hopefully that makes sense. And I can rabbit hole a little bit on the conversions, which I guess I'll do because it's important. There's 3 ways to get money in Roth. There's a straight Roth contribution and a Roth conversion of cash, and then a Roth conversion of assets. Okay, so again, Roth contribution, dollar for dollar, whatever you do is being added to your taxable income for the year. Roth conversion of cash, dollar for dollar, added to your taxable income for the year. Now, what some people do is they'll do a conversion of $10,000 on December 31st and another $10,000 on January 1st. So it's separated into 2 tax years. Incidentally, check with your CPA, excuse me. Check with your CPA on this before you do a Roth conversion, because I don't want to see you add even $1 more of taxable income to your situation. That's going to bump you up to the next highest tax bracket, because there's some nasty brackets. And so, nasty jumps rather, and I don't want to see, incur that. So check with your CPA, which I am not. And then the other way is to convert assets. And when you convert assets, you have to get a third-party valuation. And so you could convert, this is real life actually, you can convert a trust deed, mortgage, right? Owner occupied, investor, whatever. And you can go to a third-party company, valuation company, and you can say, hey, I want to convert this note from traditional to Roth. Please give it a valuation. They'll collect whatever information they need and they'll give you back a valuation, AKA an appraisal. And so when you convert it from traditional to Roth, you use that valuation. Oftentimes it comes in lower than the initial principal investment, because you are typically going to do this with an illiquid asset like a note or an investment in like a real estate syndication. It's just hard. Those are locked up, right? You're locked up for a number of years. They're not liquid. It's hard to turn them into cash. And so because of that, they're worth less on kind of a resale perspective. And so this valuation company will come in lower, pay that amount, but you're converting the entire asset and all the future payments into Roth. So it's kind of cool to do that, because you can really hack your way to more Roth for less taxes by doing it that way. Okay. Next question, please. Thank you for that.
Right. So for the next question, we have also from Joseph, how to contribute to 2024 for 401k if it's not set up yet?
Yeah, great question. So first off, get on my calendar, SenseFinancial.com/consultation. And Joel, that will help you out with your question as well. So we'll talk through your situation, but it's not too late as long as you haven't filed. Now, if you're a sole prop single member LLC and you're not required by the IRS to run payroll, and I'll talk more about the payroll side of things, but let's assume for a second you're a sole prop single member LLC and you want to make a 24 contribution. Again, as long as you haven't filed yet, it's not too late. So we can create the plan, we can backdate it to the beginning of 2024, and you can make the contributions accordingly, okay? Both employer and employee contributions. Now, S Corp, C Corp, all the contributions are required to be made through payroll. So as long as the S Corp was already created, like in 2024, we can backdate it to 2024. If it was created this month, that's not going to work. But if it's in existence in 24 tax year, we can backdate the plan just like sole prop single member LLC to the beginning of 2024, and you can make an employer profit sharing contribution only, because it's too late now, February 6th, to do a payroll for employee contributions. So when you're S Corp or C Corp, all employee contributions must be paid through the payroll. And so it's too late. The W-2 is already done. Maybe you could find a CPA that could do some gymnastics and amend a W-2 and you can run a backdated payroll. I'm not really sure. I've heard of that being able to be done through January, but I'm not sure about being 6 days into February, if that's possible. So for all intents and purposes, let's just say that you can still establish the 401k. Again, S Corp, C Corp was already a thing for the 2024 tax year, and you haven't filed yet, you could establish the 401k now and make employer profit sharing contributions only, which is 25% of the W-2 for 2024. So if you ran a $100,000 W-2, then you can put in $25,000 for the year. So, and again, spouses double all this, right? If you both get a W-2 of 100, then you're at 50 max. You need to have the money in the business to be able to pay this, but it doesn't really matter at this point. Did the money come in this month, last month, 2024? Check with your tax advisor on all of that, by the way, for sure, before you do this, but it is possible to set it up and still make 24 contributions under those stipulations that I just went through.
Thank you for that, Brad. The next question is from Joel. How can I set up a meeting for spouse and I?
Yeah, Joel, thank you. SenseFinancial.com/consultation, and you can grab a spot.
The next question is from Joseph. Is the employer 401k contribution tax deductible for business expense?
Is, yes, always. Now, you can make that as a Roth contribution, although remember what I said, it's probably better to make a pre-tax contribution, invest in an illiquid asset, get that asset valued, and then convert that asset to Roth because it's going to be at a discount. But if you want to make it as a Roth contribution, you can do that. However, it's always a pre-tax business expense initially, and then you can convert it to Roth the very next day. So we'll issue a 1099 to you for that conversion so that the money that's being converted from pre-tax to Roth is added to your taxable income. And you do it right away so you don't have an increase on interest earned, even in the checking account, right? Because all of that will be added to the 1099. So just do it like the next day after you make the contribution, if you do it that way. But yes, it is a business expense.
All right. So far, those are all of the questions for today. Brad, would you like to add anything before we conclude this webinar?
I don't think so. Thank you. Other than thank you very much for joining us today. We appreciate it. You taking the time out of your busy schedule rather, to join us and learn something maybe that you didn't know about before. So we appreciate the opportunity and hope to talk to some of you here in the not too distant future.
All right. We will then conclude the webinar here. Thank you all so much for coming. And thank you again, Brad, for holding this webinar.
All right. Thank you, everybody.